This real estate tax loophole is allowing people to reduce their taxes down to zero. We already know that real estate appreciates in value and generates consistent income. But what many people don't know is that they can earn income from real estate and still show a loss on their tax return thanks to this loophole that I'm about to share with you. Now, some people call this the paper loss tax strategy. And by the way, this is not new. Billionaires have been using this tax loophole for decades to, quote, erase their income entirely as they grow richer, allowing them to pay little to no taxes. Some did not pay taxes for nearly a decade, largely due to these paper losses causing them to report negative income on their tax returns. There are people right now who have rental properties that are overpaying their taxes because they are not using this loophole. And I promise you, there's even more people with very high tax bills that will probably invest in real estate themselves if they knew about this loophole. So today we are going to fix this. As a licensed CPA at mycpacoach.com, I'm going to fully explain to you how ordinary people can save tens of thousands of dollars in taxes from real estate investing. So let's go ahead and jump right into it. All right, so let's start by walking through a very realistic scenario. Let's say you invested in a rental property that costed you $400,000. Well, the tax law allows you to write off a portion of the cost of your property every single year. This is called depreciation. Now, the tax law gives us multiple ways to calculate our depreciation deduction. There's straight line depreciation, accelerated depreciation, bonus depreciation, and more. But I don't want you to get lost in the semantics here. As a savvy taxpayer, at the end of the day, you just want to choose the method that saves you the most money in taxes. And sadly, I see many tax returns where real estate investors fail to take any depreciation at all. Now, maybe it's because of their accountant or they self-file their tax returns to their own detriment. But the bottom line is that they end up missing a free write-off worth thousands of dollars, and we don't want that. So let's continue to walk through this scenario to make sure you understand this. All right, so on the most basic level, you can write off the cost of your rental property over 27 and a half years, which comes out to be about 3.6% of the property cost each year. Which means if we simply take the $400,000 purchase price and divide it by 27 and a half years, we would get about a $14,500 tax deduction that can then be used to reduce income on your tax return. And most people are not even doing this. So just look at this simple example. If you earn $10,000 in rental income, this deduction would erase all of that income and give you a net loss of $4,500. And that loss that remains can then be applied to other income on your tax return, which we will talk about later in this video. But first, I need to take this a step further and show you how you can accelerate the amount of depreciation you take, which would just create a bigger paper loss on your return. Because instead of writing off 3.6% of your property value evenly over 27 and a half years, you can depreciate it faster, allowing you to write off anywhere from 20 to 30% in one given year. So instead of a $14,000 tax deduction on this property, you could potentially take upwards to $80,000 to $120,000 in depreciation expense in one given year. Now, I'll explain how this works in a second, but I just want you to imagine this. Let's say you earn $100,000 per year in income and another $10,000 in rental income. A $120,000 depreciation deduction would wipe out 100% of your rental income and could even qualify to wipe out 100% of your W-2 or business income, leaving you with a net loss of $10,000 on your tax return. If you understand that example, then you understand how the wealthy are using real estate to erase 100% of their income. They buy real estate, accelerate depreciation to offset their income, and pay no taxes as a result. And they just keep buying real estate every year to continue offsetting the income they earn. Then when they eventually sell their real estate, they can do something called a 1031 exchange to avoid paying any capital gains tax on the transaction. The tax law is what makes all of this possible, which is why it's important for you to understand how to navigate this. So let's dig a little bit deeper into how this accelerated depreciation thing works. So remember earlier, I said that the IRS requires you to depreciate the entire property over 27 and a half years. But that's only if you lump everything inside of that property into one item, like appliances, furniture, carpets, fixtures, equipment, cabinets, counters, ceiling fans, and so on. Now, let me ask you this. What furniture, carpets, or fixtures do you know that will last 27 and a half years? They usually don't. And the IRS understands this. They actually classify these items as 5 or 7 year property, and there are even more items that could qualify for 5, 7, 10, or 15 year property inside of a residential home. Now, the reason why this is important is because the shorter your useful life is, the greater your depreciation deduction will be. For example, $100,000 divided by a 5-year useful life equals a $20,000 deduction. Whereas the same $100,000 divided by a 27 and a half year useful life equals a $3,600 deduction. That's a big difference. But the moral of the story here is that you can take more depreciation by identifying components in your property with shorter useful lives. This is all accelerated depreciation really is. But how exactly can you quickly and easily accomplish this? Well, all you have to do is get what is called a cost segregation study on your property, and I'll link one of my go-to vendors in the description below. But this study will identify those components of your property with shorter useful lives, and it will even calculate your accelerated rate of depreciation for you as a result of that study. Here is an example of a cost seg study I had done on a property worth about $389,000. As you can see here, the study allocated about $86,000 of the property value to 5-year property and about $32,000 to 15-year property. By classifying these components into 5-year and 15-year buckets, this allows us to have greater depreciation amounts by default. But that's not it. The tax law allows us to do a little bit more actually. So property with useful lives less than 20 years may also qualify for bonus depreciation. Bonus depreciation allows you to take even more depreciation in one given year. In 2022, you could depreciate 100% of qualifying property in the first year. Then it dropped to 80% in 2023, 60% in 2024, and it will continue to drop by 20% every year until it phases out completely in 2027. So basically, the cost segregation study will identify the components of your property with those shorter useful lives, which will naturally bump up your depreciation deduction. But then you could also use bonus depreciation on top of that to squeeze even higher amounts of depreciation, which means bigger deductions on your tax return. Remember, we're doing all of this to reduce the income you report on your tax return, which could potentially wipe out all of it. But there are some nuances associated with using rental losses to offset income on your tax return. So let's address this in greater detail. We see a lot of mistakes with this. So by default, rental income is considered passive. And when you have a rental loss, perhaps due to depreciation, it is also considered passive. Now, this passive distinction is very important because the IRS only allows you to use passive losses to reduce passive income. So you would have no problem using your real estate losses to reduce your rental income or other passive income sources like interest income, dividends, annuities, and so on. But you would have a problem using these losses to offset your ordinary income, which is treated completely differently from passive income. Ordinary income is income you earn from trading your time for money, such as through a W-2 job or self-employment. So by default, you cannot use your passive real estate losses to offset your ordinary income. But that's where understanding the tax law comes into handy, because it actually gives us a couple of ways to get around this and is completely legal. So in very simple terms, in order to use your passive real estate losses to offset your W-2 or business income, you have to either 1, turn the loss from passive to ordinary, or number 2, turn your ordinary income into passive income. There are ways to do both, but the bottom line here is that your real estate losses and income that you wish to offset must be treated the same in order for them to offset each other. To turn passive losses into ordinary losses, you can earn rental income that is treated as ordinary income by default. So specifically, short-term rentals like Airbnbs are not considered passive income. Or if you prefer long-term rentals, you can qualify as a real estate professional, which can be done by working at least 750 hours per year in real estate activities, and real estate must also be your primary trade or business. Now, I already have a full video on these topics, so make sure you subscribe to check that out. But the alternative is to turn your ordinary income into passive income, allowing your passive losses to offset it. Now, this is much harder in my experience, but it can be done if you own a business and are able to participate in it passively, which typically involves someone else running your company without your involvement. If you want to learn more about any one of these areas, just drop a comment below and I'll consider going deeper into these topics. Or if you want to work with a CPA now to help you start working on this, just go to mycpacoach.com and apply to work with one of my CPAs today.